regarding funding and capital, and how access to capital can make or break the factor of a small business, right? So, have you seen any changes in financing options or approaches available to small business owners in recent years compared to the past?
Yeah, so in one of my earlier jobs I was working as a manager at a bank. And one of my main jobs was people would come in, they'd want to start up their own business, and they'd want to get a loan. And I can tell you 9 out of 10 or 10 out of 10, I would have to reject them. First question I would ask, where's your business plan? And if they didn't have it, the conversation was done. Those that did have a business plan, we went through it, and I would ask them, where's your projections? Where did you get your numbers from? We'd have to go through the process to see if it looks solid. If they passed that step, then it was, well, let's look at your personal history. We had to go through your credit checks, credit reports, see what your debt to equity ratio was. And if it was too high, then it wasn't good. So I think now there's more options. I think with a lot of businesses going out, and I think with the economy going up and down, banks are more willing to have to spread their investments around instead of just to large companies. So they're taking more chances on small businesses, and like anything else, the more established a small business gets, the more history it has behind it, the more stable it becomes. Since they've been around longer now than they were, I would say 10, 15 years ago, banks are seeing that they're not as risky as they were. So I think you're seeing more opportunities there for loans and lines of credit and things like that. Also with technology, you're getting, Venmo, all these other different ways of Square app too, of taking payments. I know me personally, when I'm out, and I'm doing events or anything that I'm doing for my businesses, that's a great tool to have. Back then you didn't. So your ability to get funds was limited to either, say cash or check. Checks are iffy. Nobody wants to take them, and cash hardly anybody has. So I think those technologies have helped small businesses as well. Also with, e-commerce being out there, the conversion rates between, different countries are also there. So yeah, I think technology financing, there's been a whole lot more options. You can get away from, doing home equity lines of credit to support your businesses and losing your personal assets.
Right.
Also, the ability to open up, personal LLCs and kind of separate your business income from your personal income, I think has made it very positive for small business owners to want to get more into that and have more, flexibility and finance in their business.
What about funds from non-banking institutions as in investments, angel
So
investments?
yeah, like angel investors, yeah, I think they're still out there. Some are looking to make a quick buck, and that's great if you can find them. But again, there's so many that are out there. I know if you join like the Small Business Association, you can get loans at a lower rate, things like that. So I think those are good. But I mean, don't forget too, there's also very large numbers out there, and you're also competing for things. It's like a student that's applying for college trying to get a scholarship. There's all this paperwork, all this time that has to go into it. It can have a great payoff, but if you're going to do that, I mean, you have to make a really solid case.
Right.
An example that I like to give is, when you watch Shark Tank, you got a great idea, but when you're pitching it to the panel, it's more than just that idea. You've got to have a plan in place, and no one's going to give you money unless they think they're going to get an investment back. So it has to be a very solid plan for, when you're at that stage to convince someone to just give you money.
Right. Got it. So, you would suggest what would be a good time for a company to take up a funding? Would it be from the start or after building a good base?
So a lot of people, my answer is going to be both. A lot of people think that once their company is going, that's the time to go get the financing. It's actually the opposite. You want to try to secure that funding in an ideal world ahead of time. The reason being, especially if you are a goods-based industry, you're going to go through that supply curve, and that's going to go, up and down through introduction, growth, maturity, decline. You want to make sure you have your funding there so that way you can already have something launching and you have enough capital left over so that way you can continue to grow and be sustainable. If you're a one-shot pony where you have that great product that starts to go down, by the time that you're going to the investors, you've already hit your peak. They're not going to invest at that point when it starts to decline. You want to get them on the way up. So I would say earlier on is good. Now, if you are expanding your business and you've got a good solid line, then it's good to say, okay, here's my financials, here's what I've done, here's a different direction that I'm thinking about going. I'd like some investment to help grow this. But there's always that question, it goes back to the phrase with them, what's in it for me? So when
Right.
you're going to that other business, you're going for that loan or you're trying to get that funding, you want to be able to show them how that's going to help them as well. And like I said, when the economy is bad, it can go either way. It's a risk. So who you choose, the reputation of the company, is going to play a huge part in making that deal and getting that funding.